part C, explain how the material variances calculated in B should be treated in the accounting records. So that's for 7 marks, and then there's 1 mark available for communication skills, and that is awarded for clarity of expression. Alright guys, so in part B we calculated all of the material variances, and now we just need to explain how those variances should be treated in the accounting records. Alright, so let's just go back to the information provided in the scenario. You'll remember we were specifically told that inventory is valued at standard cost. And when we read through the information provided in the scenario, I explained to you that in terms of IAS 2, this is allowed. Companies are allowed to value their inventory at standard cost. However, the standard costs must approximate actual costs. Now remember, we calculate variances by comparing the actual results to the standards. So the fact that we calculated variances in part B of the required means that there's a difference between the actual results and the standards. So for each of the variances that we calculated in part B of the required, we need to explain how those variances should be treated in the accounting records. So we have one of 2 options. Either the variances can be taken to profit or loss. So if we have a favorable variance, it will be treated as income in profit or loss, or if we have an unfavorable variance, it will be treated as an expense in profit or loss. Or as an alternative, instead of taking the variance to profit or loss, we can take the variance to inventory by adjusting our standards. So let's go back to the variances that we calculated, and we can discuss this for each of the variances that we calculated. So first, if we look at the material price variance for cookie dough, we had a favorable variance of 2.1 million rand. Now, before we can determine whether that variance should go to profit or loss, or whether we should adjust the standard and revalue inventory, we need to determine what the cause of that variance is. So if we go back to the information provided in the scenario, the reason why that variance is favorable is because the supplier of cookie dough moved premises during the year, and they offered significant discounts in an attempt to sell all inventory on hand before the move. The supplier's new premises is now 5 kilometers closer to Sweet Treats, and discounts like this are not expected again in the future. So this tells me that the standard is not incorrect. They were not wrong when they set the standard. The standard is also not outdated. This is once off. This is not expected to happen again in the future. So we are not going to go and adjust our standards and revalue inventory. Instead, we are just going to take the variance directly to profit or loss. And because it's a favorable variance, it will be treated as income in profit or loss. Then for chocolate chips, we calculated that the material price variance is 760,000 Rand unfavorable. So once again, let's go back to the information provided in the scenario to determine the cause of the variance. You were specifically told that due to inflationary pressures, the cost of chocolate chips increased at a rate higher than management predicted when the standards were set. So when the standards were set, management anticipated that the price of chocolate chips would be 200 Rand per kilogram. However, because of inflationary pressures, the cost was actually 202 Rand per kilogram. So this indicates that the standard is outdated, and the variance needs to be accounted for by updating the standard and adjusting the value of inventory. So that deals with the material price variances. Then after that, we calculated the material mix variance and the material yield variance. Now, I'm not going to discuss these separately because you'll remember the sum of the material mix and yield variance gives us the material usage variance. And we proved in part B of the required, if you go back to the explanation where I explain how losses in the production process work, we explained that the material usage variance is because of an abnormal loss in the production process, not as a result of a normal loss in the production process. And we know in terms of IAS 2, abnormal losses are not included in the value of inventory. Abnormal losses must be expensed in the period incurred. So the material usage variance will not be taken to inventory and we will not adjust standards, but instead the variance will be taken to profit or loss. And overall we had an unfavorable material usage variance. So that means because the variance is unfavorable, it will be expensed in profit or loss.